subscribe now and press the bell icon. Never miss an update.
This is what we did yesterday. We were looking into what is the difference between a dealer who is holding stocks and bonds and commodities versus an investor, right? So we know something which is held for investment would be called as capital asset, but this is a dealer. What the dealer does or what the trader does is mainly for business, mainly for making commissions out of that purchase and sale. So we cannot call that as an investment. Either like that, or they are doing trading, or they're looking for trading income, maybe not really working as a broker, but then just doing daily trading or daily trades and then looking for more of a trading income. And in that process the person may even hold the assets for some time. So again, we have to use our judgment. There's no such like fine line, there's no such black and white saying that okay, if the person is holding for 15 days or 20 days, let's treat that as a capital asset, otherwise not. We have to see all these different facts and circumstances, that what is the intention behind the transactions which are being done by the dealer. What is the nature of the activity? It needs to be substantial, needs to be done every day. An investor doesn't go around and keep buying and selling every day. They'll probably once in a month or 2 times in a month will go and buy some stocks and keep it. Right? They may even sell it in 5 days. Again, that doesn't mean that they become a dealer or a trader. How much regularity and continuity we see in their activity. Okay, so we'll have to use our own judgment and make a clear distinction between what could be considered as a capital gain transaction versus an ordinary income transaction. This is where we stopped last time. Land investment. So any land which is primarily held for investment, obviously it will be a capital asset. Okay, but if the land is subdivided, it may be treated as converted to property held for sale, and then it may become a a business asset, or maybe like an inventory kind of thing, not really an asset. Because if there is a builder or somebody has taken a huge piece of land and then plotted it and then selling off the plots, then those plots they become inventory. They're not investment anymore. But mere subdivision for land doesn't mean that it's going to get changed to property held for resale. It may still be an investment property. Just by saying that, oh yeah, this has been plotted, oh yeah, they've been they made done these, it's not a continuous land anymore. They put some boundary wall and all that doesn't say anything. We have to see what is the intention. Is there a business which is being carried over there, or what is that person intends to do? The person wants to keep it for a few years and then sell it off, or maybe sell off a piece of it every year or every other year. That will help us understand what is the activity behind it. Sale or exchange. Okay, so there is something section 1001, and what it says is all gain losses are realized on the sale or other disposition of the property. So all the gains or losses, if there is a sale or if there's a disposition property or if there is an exchange with another property, that is the time we need to realize any gains or losses, or at least look into the possibility that there could be gains or losses. Okay, this includes sale or exchange that are required in characterizing a realized gain or loss as capital. Let's just see here. What is a sale? Sale is a transfer of property. We all know that. Okay, the property is changing hands in exchange for something. It could be money or it could be some other property with some value. Okay, it's an exchange for money, while an exchange is a transfer of property in return for other property or services. But still, the gains or losses need to be recognized. For real property, or sale or exchange occurs if it's a real property, if it's a real estate, it's an immovable property like a building or house or something. A sale or exchange occurs on the earlier of the date of conveyance, meaning the title which has been passed to the new buyer, or the date that the burdens of ownership pass to the buyer. Whatever is earlier, if the title has been signed, it has been given, fine, it's done. Maybe the title has not yet been signed. Maybe sometimes it takes months, to do the title registration and all, or maybe the deed has not been put up in place. But who carries the burden of ownership? Again, those facts and circumstances will give us the answer for that. Who is in reality a owner of it? Maybe not on papers, but still, as the burden of ownership transferred to that new buyer. If yes, then we'll have to take that date as the date of sale or exchange. Any liquidating distribution and losses on worthless securities, if the securities have gone under the waters, or they are worth nothing now, or there are huge losses on it, that basically we are not able to sell anything. Liquidating distribution, if the company is selling off, they're just like giving a part of whatever they can. So those will also be considered as sale or exchanges, and the same amount of capital gain or capital loss will be applicable to that. We may have to write off worthless security. Sometimes the company itself is delisted, even though they're public companies. Maybe they get delisted from a stock exchange. Or it becomes such a low number that we actually cannot get anything. And we have seen that happening in 1990s and 2006, 7 and all, when the stock market crashed. There were a lot of worthless securities and all. Okay. So let's see, all realized gains must be recognized. Okay, this is an important statement. Let's again pay attention to it. Okay. What does the code say? All realized gains must be recognized unless the Internal Revenue Code expressly provides otherwise. So, see how well they are covering the law in their favor. What they're saying is all realized gains just have to go and put it up for tax. You have to report that unless there is something written in the code that says, or by code I mean law, something written in some section that says that okay, this income is exempt. Conversely, that means in the opposite way, no deduction is allowed. No deduction is allowed for a realized loss unless the code provides for it. So even if there is a loss, you may not be able to take a deduction saying that okay, there is a loss, I want to reduce the other income. But there has to be expressly mentioned. Otherwise, it's not allowed. So in both the cases, you know how it has been structured that the entire burden falls on the taxpayer, and they just write the code saying that okay, all income, yeah, put up for sale, whether we mention it or not. Sorry, put up for taxes, whether we mention it or not in the code. But all deductions, no, 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 don't take it. We have to specifically talk about it in the law. If you don't see it written in the code, no deduction allowed. Whether it's a genuine and not genuine and all, that's all different thing. So we also need to remember that we cannot just go with our assumption, well, yeah, this is a deduction, it's very reasonable. If we are putting that income, we are reporting it for the purpose of taxes, it's assumed, it's implied that we should be also able to take a deduction against losses. It's nothing is assumed or implied. We have to go and check what the law says, especially if that is giving benefit to the taxpayer. Okay. So obviously, how to figure a gain or loss? Well, we have to see what is the adjusted basis. Obviously, basis is more than the sale amount, there's a loss. If its basis is more, then there's a gain. Again, no, we don't need to spend any time on that. Everybody knows this. This is a very basic. Even a primary school kid will also know how do we have say like gain or loss, right? What is the cost? What is the sale amount? But what we need to pay attention is how the basis is calculated, or if there are different components there, like say what is the fair market value. If you are that, any relief on the liability, meaning any loan which is being assumed by the buyer, any other money or property given up as part of that deal, any selling expenses and all those things. Okay, so if we have gone through this rule earlier also, if FMV of other property received is not determinable, if we are exchanging the property, one property is being exchanged, usually what we'll do is, okay, if I am exchanging my property with somebody else's property, I will see what I'm getting. So, what is the fair market value of the other person's property, and I'll take that as my uh, sale amount, because that is what I'm getting. But what if I'm not able to ascertain the fair market value of that? Then we have to take the what is the fair market value of the property given up is used, because it's an exchange. It's typically it should be happening at the same level. So we have to go to the fair market value as of that date. Any liabilities which are assumed, whether they are recourse or non-recourse liability, does anyone remember what is recourse or non-recourse?
Ma'am, in non-recourse debt, no personal liability occurs.
Correct. The personal assets are attached, right? Or it can go to the personal liability. We have seen that in when we were doing the partnership or something, right? The partner may have a recourse or non-recourse liability. Good, very good, Garima. Then selling expenses, yes, we know what are the selling expenses. They can be legal fees or commissions, brokerage, and all. So let's go over this example, then we'll make it more clear. Okay. Muskan, 9.6.
The purchase price of a building was $400,000. That is
Yes.
$100,000 cash plus $300,000 mortgage. 2 years later, improvements of $80,000 were made to the building. The building sold for $700,000. That is $600,000 cash plus $100,000 mortgage balance. A total of $180,000 depreciation had been taken as of the date sold. The adjusted basis is $300,000. That is $400,000 original basis plus $80,000 improvements less $180,000 depreciation taken. The realized gain is $400,000. That is $700,000 cash and liability relief less $300,000 adjusted basis.
Okay. Tanya, can you explain this?
So first we have to see what is the cost of building. The cost of building is 400k, $400k, because the buyer has paid 100k in cash and 300k mortgage liability the buyer has accepted. Now after 2 years, buyer did some improvements which were costing 80k. So now the cost has become 400k plus 80k, which is making it 480k.
Perfect.
The building was sold for 700k, again some cash amount and some mortgage buyer has taken, the new buyer has considered that. But over the period, the owner of the property has claimed a depreciation of 180k. So the adjusted basis will be actual cost paid plus improvements minus what benefit as depreciation is already claimed by the owner, old owner. So that makes the adjusted basis as 480k minus 180k. So it's coming to $300,000. And the property was sold for 700k. So the capital gain is 700 minus 400k, 300k, that is 400k.
Right. So what this example is telling us that we need to adjust the purchase price, which, and that's why we call it AB as adjusted basis. If we don't have to adjust anything, we'll just go with the purchase price 400,000, sold for 700,000, take the difference. But no, what has happened? There were improvements which got added as, which got capitalized. There were some depreciation which got adjusted. So the value has to go down of the property, or at least on the books, the basis has to go down, not the value. Okay, and so accordingly, we'll calculate what is the gain. Now let's see what is LTCG, LTCL. We all should be aware of these words. If you, I mean, these acronyms, if you don't know it. LTCG is long-term capital gain, long-term capital loss. Anything which is held for more than 1 year will result into long-term. Less than 1 year, it will be short-term. It's very simple with US gains and all, US capital gains. Just go with 1 year rule. We don't have to see whether that, okay, for certain assets it's 24 months or it's 36 months or it's 12 months and all. Generally, it will be only 1 year. Maybe I would say 1 year more, 1 year less. Okay, less than 1 year. So that will tell us whether it's short term or long term. Now, this is important. What is net capital gain? Net capital gain is the excess of net long-term capital gain over net short-term capital loss. So what we are doing is we are first saying what is our total long-term capital gain or capital loss. That means long-term capital gain will offset long-term capital loss. So net of that we will see. Then that can get reduced by any short-term capital losses. We are not including short-term capital gains. Okay, we are not including short-term capital gains when we are calculating not net capital gain. Why? Because short-term capital gain will go for ordinary rates when it is being taxed. Short-term capital gain is considered as ordinary income for individuals. It gets taxed at the ordinary rate, whatever bracket you fall under. So it's very important on Schedule D when we see what is the total net long-term gains, short-term gains, what is being offset against each other. We need to understand how this NCG works. NCG rates do not apply to net short-term capital gain. Why? Because the ordinary rates will be applied. So once again, let's go over it. What is net short-term capital gain? Wherever net comes, that means we are taking into account two different values. So what they're saying is you take short-term capital gain minus short-term capital losses, whatever we come up with, that is our net short-term capital gain. Now this net short-term capital gain is not part of net capital gain because this is considered as ordinary income because it is short-term. But if there is a long-term capital loss, then we can use short-term capital gain and reduce that gain by these losses. So the gain can definitely be reduced by long-term capital losses. Okay, but usually what we need to remember from here is anything which is short-term will go for ordinary rate. We cannot put them as net capital gains. They will go as ordinary income. But yes, if there is a long-term loss and a short-term gain, then that loss can reduce the short-term gain. They can offset against each other. Okay, I hope we are clear here. Let's go to capital gain rates. Yes, go ahead. Does anyone has any question here?
Ma'am, if there are short-term capital losses,
Here it
then
is. That is getting offset against the
against
capital gain.
short-term capital gains.
Yeah. It will also get offset against long-term capital gains also.
Okay.
But then, Nitika, it's beating IRS purpose of getting tax at higher rate if short-term capital gain is offset against long-term capital loss.
Yeah, but that's true. But then again, this is related to the property. So yeah, so they are giving that benefit, but what they are not like only to the extent there are losses, you can reduce that.
Oh wow, great.
Okay. So what are the capital gain rates? The capital gain rates can go from 0% to 28%. Depends on where the person's AGI is falling under. And so what they're saying is these threshold for the application of capital gain rates are adjusted for inflation. Well, that's okay. Every year some of these numbers are adjusted. All our thresholds are adjusted. They're adjusted for inflation only. There is nothing called indexation in US. We don't do any indexation there and all. We don't see what is the cost of living in particular year, how it has gone up, and then all those inflation thing, nothing like that. Because every year IRS is saying that we are giving higher limits. So that is after adjusting inflation only. Now, there is quite possible, and we have seen that in many tax returns, that in spite of having capital gain income, there's no tax liability coming. You need to go to, when you're working on those tax return, go to that tax calculation worksheet. See why it is not coming. There is a full like half a page worksheet there where it will tell you what is the capital gain income, what is qualified dividend income, and it will tell you whether it's falling under 0% or 15% or 20%. Why that happens? Because the income for different filing status may be under different thresholds, and accordingly they will go into different categories. So again, this is very helpful for us to know, because a lot of planning can be done that way. If a person who does not have much income, or say married filing jointly category, they don't have much income, maybe their total income is around $50,000, and if they're planning to sell some assets, which may lead to some capital gains, it may actually happen that they may completely get away from the tax liability. They may fall under 0% category. So under $83,000 and all, they may not have to pay any taxes. And if they cross 83,000, they will be paying 15%. If they cross some more, they may go up to 20% and all. And there is a category for 28% as well. It also depends on the nature of the asset. We are not looking into it right now. We are just seeing like only one category of asset, but there could be something called business assets. There could be, there could be some other categories which are only going for 28% rate, like the recapture of the business assets, like the depreciation has been recaptured when you're selling that often. So in spite of these threshold, it may actually happen that there might be a 28% tax bracket person may fall into, because we have to see, and usually those brackets will come only if a business asset is being sold. If it's a personal asset like your house and all that you're selling, the structure is very simple, because the individual has not made any money out of it. It's a simple family or person who is just having a house, they're selling it off and all, or they're having some stocks, or they're having some other items which could fall under the category of capital asset, and they're selling it. But when you're selling off a business asset, because you have claimed depreciation on it, you must have had some other benefits on it, you must have got some credits on it and all. So we have to see, they may go into higher tax rate. Yeah, so they're saying here the capital gain rate is 25% on recaptured Section 1250 gain. Now, a lot of you will not know what is Section 1250. But that's okay. We will go over these things later. But Section 1250 will come into the picture when there is a business asset. And usually Section 1250 is for any real property. Section 1245 is for personal property, meaning like business property only, but then it could be movable property. And usually 1250 is for the real property, which is immovable. Again, the capital 28% rate is put up on the taxable portions of gains from 1202 stock and all. So what is 1202? This is called QSBS. We have seen that up to 10 million of that can go for a waiver and all. And in spite of getting a waiver, if there are any taxable portion of gains still left, because the waiver is up to certain limit, right? After that, what IRS is saying, okay, now enough, we've got you enough waiver. Now whatever you are having income above that, even though it's capital gain, but we will put 28%. So there might be some kind of clause and conditions on these situations. We'll have to see. This is not very common or popular kind of situations, but It can happen. Yes, they definitely exist. That's why they're saying the rates can go from 0% to 28%. Okay, they call them as different baskets and all. So one thing is that losses for each long-term basket are first used to offset any gains within that basket. So maybe the basket, you say that, okay, this is 28% basket, this is 25% basket and all. So basically one group has been made. So you first do the offset between that one group. If you are left with some losses or gains, then you offset the next level of gain. So start with the highest and then go to the lowest. And this is what we will see in this example here. Okay, Bhavani, 9.7.
Yes. Capital gains, losses, and grouping by tax rates. Taxpayer realizes a $10,000 net loss in the 15% basket, a $5,000 net gain in the 25% basket, and an $8,000 net gain in the 28% basket. The taxpayer will first apply the net loss against the gain in the 28% basket, reducing the gain in the basket to zero. Then the remaining $2,000 loss is applied against the gain in the 25% basket, leaving a $3,000 net capital gain in the 25% basket.
Okay, Shweta, please explain.
So a taxpayer has a net loss of $10,000 and he has a gain of 5,000 in 25% 25% basket and 8,000 net gain in 28% basket. So to offset the losses against uh, gains, he will first utilize this $8,000 which is in 28% basket to reduce the tax liability. And balance left over is 2,000 which will be in 25% as basket.
No, no. So balance left over will be 2,000 net loss, which is still lying in 15% basket. But now next what he will go is will be 5,000 because there's nothing else available. Right?
No,
So he has
the
used all of his
10,000
gain. Correct. So
8,000
10,000.
from 28% basket and 2,000 from 25% basket.
Perfect. Perfect.
3,000 is
Yeah.
left over.
So leaving a 3,000 net capital gain in 25% basket.
Yeah.
Why 25% basket?
Because it is in that net gain in the basket of 25%.
Right. So I know it's a very basic question, but I still want to emphasize that he has used first all the gains of 8,000, made this as zero. Okay, everything has been used in 28%, made this as zero. Then he went to 25% basket. Okay, let me use that remaining, whatever I can. But he has the leftover was only 2,000, so he could use 2,000. Remaining 3,000 will obviously go for 25% rate because this comes from 25% basket. Are we clear on how the what order we need to follow when we are applying or when we are offsetting gains and losses?
Yes, ma'am.
Okay. Okay. If we'll just we'll continue. So carry over of net long-term capital loss, NLTCL. Carryover of net long-term capital loss from a prior year is used first to offset the net gain in the highest basket and then continues down and on. Same concept. Even if it's a net long-term capital loss, which is being carried forward or which is being carried over. And similarly, net short-term capital loss is also first used to offset the highest basket gain and then it will move on to the next, the lower than that and then lower than that and all. Okay. Can Hemant read this 9.8?
A taxpayer has a $1,000 long-term capital loss carry forwards in net short-term capital losses of 3,000, a 1,000 net gain in 28 basket, and 2,000 net gain in 25% pass. basket and 5,000 net gain at
So what
15%.
others should do is, if you have a copy and pen, please write it down. Write down what is the carryover, $1,000. Okay, let's do right there. I mean, I'm also doing the same thing. So the capital loss carryover is $1,000. Short-term capital loss is 3,000. Then 28% rate, the gain is plus, I will say 1,000. 25% rate plus 2,000. That is the gain in the 25% category. And in 15%, we have a gain of 5,000. Is that right? Yeah, I put it right. So
The
now this is what our picture looks like. Okay, go ahead now. Hemant.
both losses are the first appealed to the
Applied.
offset applied
So,
applied offset the 28% rate gain using $1,000 loss.
okay, so
Right?
where are the losses that we have? We have carryover of $1,000 and we have short-term capital loss of $3,000. Correct? Those are the only two losses we have, right?
Yes, sir.
So we are first going to apply that loss to 28% rate gain. How much is the gain in 28% category? Did we write it down?
1,000.
Sorry?
1,000.
1,000. So we are going to reduce that 1,000 using the carryover first, because the carryover is a older loss than this year loss. So first, let's use carryover until it is completely exhausted. Hemant, continue.
Since no gain exists in 28% basket after applying the carryover, the net STCL, the net short-term capital loss, and then applied again is the next highest gain in 25% basket. Since no gain exists in 25% basket after
Wait. Hold on. So the short-term capital loss is then applied against the next highest gain in 25% basket. What was the gain in 25% basket?
2,000.
2,000.
2,000. What was the loss that we need to apply?
3,000.
3,000.
Correct. So we are still left with $1,000 of short-term capital loss.
Loss.
Yeah. Go ahead, Hemant.
there is
Prince.
no gain exists in 25% basket after applying the $2,000 of the net short-term capital loss, and the remaining 1,000 net short-term capital loss is applied to 15% basket. As result, only 4,000 net capital gain remain in the 15% basket.
Right. Because in 15% basket, how much was the gain earlier?
5,000.
5,000. So Ayush, after you apply, how much gain will be left over?
Ma'am, 4,000?
How much would be the tax on 4,000?
15%.
15%.
Yeah, so $600. Okay, clear? Okay, let's go next. So for corporation, there is nothing called short term, long term, and all. Everything gets taxed at regular tax rate. Loss limits. What is the limit? So if there are gains, they may get applied to prior year carry forward losses. The gains can completely become zero, which is again a very regular kind of rule. That's what we see happening everywhere. But if there are no gains, then also we can reduce our ordinary income by $3,000 every year. For married filing jointly, or for married filing separately, it could be 1,500. So this 3,000, we will always see that it will come up automatically from carryovers. Okay. An individual may carry forward any excess capital losses indefinitely. But what we need to remember is, if the client comes and tells us, well, I have $400,000 of losses sitting or $100,000 of losses, why am I asked to make such a big tax payment? I have so much of losses. But we need to tell that we cannot take your losses against your regular income. They can just offset your gains in that category, or your short term or long term capital gains only, not other income or other gains. But after that also, if you've used everything, more when there is excess that you can take, which could only be up to $3,000. So plan it in a way when we know that there are losses sitting on like clients' tax years and they are being carried forward. Maybe if the market is good, he can really make good money by selling off some stocks and all. Maybe then there's no harm in selling, because there will be no actually tax liability. There are enough losses. Let's use those losses. Okay. A corporation may use capital losses to offset capital gains each year. Corporation must carry the losses 3 years, carry back the losses and forward 5 years and all those things. So it's not very commonly we don't see with corporations. First of all, they just get taxed at the regular rate, but still, even though they're being taxed at the regular rate, still there could be some carry forward losses and all in the capital category. So how would they be used? This is what they're saying. We have to first see if they can be carried back, otherwise carried them forward. Let's look into Schedule D. This is important. You will always see this form Schedule D. Schedule D basically summarizes all the long-term gains and all the short-term gains and losses. And it comes from Form 8949. So Form 8949 is also very important. Form 8949 we will do all the computation on Form 8949, like what is the total gains, total loss and all. And that all information will get forwarded to Schedule D. Schedule D is attached to Form 1040. Like how we have seen Schedule A, B, C, now we're talking about D. Okay. So that's, I think we all know about these things. So yeah, so there might be one thing we need to remember is there could be capital gain distributions. Even though the person has actually, the taxpayer has not sold off any asset, still they may have capital gain distributions. How does that happen? Because a lot of times they put their money into mutual funds. They give certain parameters to the mutual fund company or brokerage company that this is this is the category where I want to stay invested, or this is my target fund, or I'm looking for, so, and my risk taking appetite is only this much and all those things. So based on that, a fund can be recommended to them by brokerage company and they put money there. And a lot of times the brokerage company will have a control on that. They may buy and sell, or they may move the funds around to make sure the customer's requirements are met. In that process, there could be capital gain distribution. So that this is something very commonly we see, and this will always come up on Form 1099 Div. Yeah, 1099 Div. It will come up on Form 1099 Div, but it gets taxed on Schedule D as a capital gain item. And sometimes the customer will say, well, I never sold off anything. I don't know what you guys are doing. Where is this coming from? Can you check where is it from? So don't be surprised. Even you know that, okay, yeah, we haven't received any 1099B. So there are no sale made for any stocks. Why is it coming? We should immediately see 1099 div that maybe there are some capital gain distributions. From there, the moment we put it into box 2A, Form 1099 div, immediately it gets reported on Schedule D. And it will come up on the same rates as what has been given above, based on the income and all. Any kind of, like, there are some collectibles. If people are into collectibles and all, they will always go for 28% category, which is the highest category, because again, collectibles and something, this is all like, hobbies of very, very, maybe rich people and all. It's not meant for common person. If there's some expensive collectibles they have, so IRS wants to tax them at the highest possible rates. Form 4952, this is for investment interest expense deduction. You may get it, you may not. We'll have to see. If certain conditions are met, then you may be able to get that. And any liabilities discharged in bankruptcy are treated as short-term capital loss. This is again important. If there are any liabilities discharged in bankruptcy, it could be a loss for the creditor, right? The person who has lent the money to business and the business is declaring bankruptcy. For that person, it's a loss. So it is always considered as a short-term capital loss. IRS wants the taxpayer to take that advantage because bankruptcy is again a very unfortunate event. So they're saying the loss is short-term capital loss regardless of how long the debt was in the hands of the creditor. If it's due to bankruptcy, so if our client comes and tells us, well, I have put so much money in this company, now they've declared bankruptcy, they're like going, the winding down and all, and it's like company has nothing to give. We can see like, can we take that bankruptcy clause and put that as a short-term loss? Okay, with this, we have finished our capital gain chapter. We will start with something new tomorrow. Any questions so far? Okay, then we'll close it here.